technical things. So Dave, you are the presenter, and we're going to be seeing your desktop here in just a second. Go ahead and hit the, there we go, show my screen. Okay, ready to go. Take it away, David.
All right, Mike, thank you very much. Appreciate the introduction, and you can see my screen, it sounds like, so so we're off to a good start.
Yes, sir.
All right, perfect. Well, thank you very much, Mike, for the opportunity and for the introduction. We consider American Independent Marketing AIM a key distributor of ours and appreciate any and all opportunities to work with your agents in bringing programs like the one we're bringing today, to fruition. Before we get started, just a couple of things. First and foremost, a thank you to all of you who have decided to participate today. We appreciate. I certainly appreciate the time you provide, that you take out of your day to participate in these type of webinars. But more importantly, thank you for your commitment to this long-term care insurance industry. Each and every day we do things that are incredibly meaningful, and we should never lose sight of that. And the good news is, while we've done a lot of good work over the years, there's a lot more work to be done and plenty of opportunity to help people in their long-term care planning needs. So first and foremost, thank you. What I wanted to do today, just I'm a firm believer in repetition, so I never look at anything as kind of the beginning and end in one fell swoop. I look at it as, let's start a dialogue, let's provide some information, and then let's keep the lines of communication open to help agents and advisors down the road, in the area of long-term care planning. So for me, I consider today kind of a fresh beginning. Some of this may be old hat for those of you on the line, and again, being a firm believer in repetition, that's not a bad thing. Maybe we'll say something a little bit different that sticks in. But what I wanted to cover today was, why everyone should consider having linked benefits in their business plan. We'll talk a little about our particular linked benefit solution called Total Living Coverage. We'll get into a little bit of a high-level comparison. We think we stand up pretty good to the competition, and we're certainly getting some traction there. And then we'll, kind of talk through a little bit of the process and some of the things behind the scenes. So let's jump right into it in the interest of time. When you think about linked benefits and what they are, it's important to kind of get calibrated to exactly what we're talking about here. And when we talk about linked benefit products, typically we're talking about life insurance products that link the great features and benefits of both life and long-term care. And generally, they're providing benefits either in the form of a death benefit or long-term care benefits, generally on an income tax-free basis. So again, life insurance chassis, combining the features and benefits of life insurance plus long-term care insurance. Here's why you're seeing a lot of carriers excited about being in this linked benefit space or making significant strides day in and day out to get into this space. There's been tremendous growth over the last few years when we look at the market for linked benefit products. And when we think about just Genworth, getting in the business, 6, 7 years ago, 5, 6, 7 years ago, you could see our linked benefit has grown substantially as well, similarly to what you're seeing in the overall market. So submitted premium growth in 2010 over 29 was 124%. Our placed premium growth 2011 over 2010 was 88%. Submitted and placed premium growth in 2012 over 2011, 44 and 34% respectively. This continues to grow. We're excited about this solution as well as our traditional long-term care insurance solution as vehicles or tools to help people in the long-term care planning paradigm. Now, who sells our linked benefit products in the industry, whether it's Genworth's Total Living Coverage or the competition? It's people who are just like yourself on the line today. Independent agents, maybe some career agents, but when you look at it, over 50%, are independent agents and advisors working in some of the financial institutions that are out there. So this is something that has traction. It's not just a niche product per se from a distribution perspective. It's fairly familiar and utilized on a day in, day out basis. When we think of the long-term care marketplace, this might be one of those repetitive slides. We've been using this for quite some time, but generally speaking, when we think of the marketplace, we look at consumers falling into one of three categories. And you've got those who fall into that category of traditional long-term care insurance purchasers. They had a family experience perhaps, and they recognize the need for long-term care insurance, and they're willing to put dollars out for a pure protection vehicle as a solution, and that really is that traditional policy. When you look at that and you look at any of these statistics out there, anywhere from 4 to 10% penetration rate. So, we really have not hit a huge segment of the marketplace with this one solution. The other category that people are falling into is this one of being a self-insure. So, I've done well for myself. I've set aside some money for a rainy day. I expect to use, my own assets or income to fund a long-term care need if I had it. And I'm just not real bullish on paying premiums to something that, if I die, I don't get anything out of it. So, they're self-insuring that risk. Well, really what we believe is for those self-insurers, this linked benefit solution is the one that might be appropriate for them. And then finally, the third category is the no health, no wealth. And, really that's the Medicaid solution, the public option, if you will. And that serves a vitally important part in this equation, but it's really, just the third category of folks that fit into this LTC marketplace. The bottom line is 96% or somewhere in that neighborhood of the adult population is not covered by traditional long-term care insurance, and that just begs for maybe there's some additional solutions we need to bring to bear to solve this long-term care planning event that will occur. So when we think of linked benefits and we think of Genworth's total living coverage in particular, we're really talking about a more effective way to self-insure. And it really centers around an asset allocation approach. If you ask somebody the question, in your long-term care planning setup, if and when you had an extended health care need, where would the money come from? They're going to, you're asking them to identify the resources inside of their own financial portfolio that would pay for that need, because it's got to come from somewhere. There is no free lunch, so to speak. So really what you've asked is, if you have that extended health care need, what funds would you liquidate first for your long-term care event? And typically they're going to identify, liquid, items, cash, money markets, maybe CDs. And really all what we're talking about is there a better way to self-insure by considering an asset allocation transfer of maybe a CD that's coming through, coming to maturity into a total living coverage contract that will be leveraged up to provide more life insurance and additional long-term care benefits, and basically have a portfolio that is richer and more useful, if you will, should you have a long-term care event in the future. So really just an asset allocation approach. When we think about potential funding sources for linked benefit contracts, total living coverage, about a quarter of our sales today at Genworth, total living coverage sales, are coming from 1035 exchanges. So existing life insurance contracts that have cash value, that are outside the surrender period, that are simply being moved to another total living coverage life contract with long-term care rider as a 1035 exchange, in providing equal or better death benefit, but also long-term care benefits in the form of an accelerated benefit rider and extension of benefit rider. I like to pause just a little bit on this slide to kind of highlight something, because I think it's a little bit of a sales tip, if you will, maybe a little bit of a power phrase. I don't like to use that, but whatever, it may work here. One of the best questions you can ask your clients, and when you're doing your fact finding and you're starting the long-term care planning, is when you ask them about other other financial products, you might ask them about their life insurance portfolio. And a real benign, easy way to ask a question would be, I'm just curious, do you have the old life insurance or the new life insurance? And what do you think happens? When you ask that, they kind of go, head probably tilts to the side a little bit, and they say, well, what do you mean? Well, old life insurance typically is, you buy life insurance, and should you die, your beneficiaries will receive a death benefit, income tax free. The new life insurance is same thing. It's a life insurance policy, and if you die, your beneficiaries will receive a death benefit, income tax free. But if you live and you happen to need some care, you also have long-term care insurance available to you in the form of accelerated benefit and extension of benefit riders. Are you interested? So just a little bit of a opportunity to ask maybe one or two additional questions in the area of what the financial portfolio looks like that will ultimately drive you to that asset reallocation strategy. I think it's a significant one. So when you think about, we're going to transition a bit here, and we're thinking about our linked benefit product solution in total living coverage. Really, we're covering all the bases. So your client's care is covered, your client's life is covered, and your client's decision is covered. And what we mean by that really is, said a different way, live, quit, or die, you're going to get something from your total living coverage contract. So if you live and you experience an extended health care need, you'll have some long-term care benefits inside your total living coverage contract. If you die, your life will be covered for your beneficiaries in the form of an income tax-free death benefit. And number three, if you decide to quit, you no longer want this policy, it's not appropriate for you, you can get all your money back in the form of a return of premium. We'll talk about that a little bit more. So live, quit, or die, you get something from this contract no matter what. It's kind of a win-win-win situation. So let's just, I'm not going to get into each one of these categories here, but when we think about, our total living coverage product, we've got kind of an old and a new, and it really becomes a function of which states have, approved the newer version versus are still on the older version. They're both tremendous products and provide a tremendous amount of value. So it's not like one is watered down versus the other. It's more of just a state approval. But I think there's only 4 or 5 states that are still on the old one. California, Florida, I think come to mind. I'll show a map in just a bit. But when we look at the difference between old versus new, really the only areas that are meaningful, it's really in the area of return of premium. So on the old product, we have a return of premium for the first 15 years. So anytime during the first 15 years you choose to return your policy to Genworth, we are going to give back to you the greater of the net cash surrender value or your initial deposit. So that's in the first 15 years. Now the average buyer is 67 years of age of our total living coverage contract. The average claimant is about 82, 83. Math seems to work right there in terms of that 15 years. You're not having a lot of people wanting to turn in their policies after that 15 years. So so in terms of that lifetime piece, not as significant as it may seem. The new version of TLC has a lifetime return of premium after the second year. So you keep it for 2 years. Anytime after that, again, you want to quit and get out of this contract, we'll give you your initial deposit or the greater of your initial deposit or the net cash surrender value. Not going to go through each one of these. The other area that I'll highlight is in the area of the current and guaranteed interest rate. On the old contract, our current rate of 3.5% equals what the guaranteed rate as well. So that is what you are being credited, and it is at the floor. The newer version has a guaranteed minimum crediting rate of 3%, but the current rate is at 3.85%. Those are meaningful numbers because it speaks to the value that you get in your contract in the form of death benefit or long-term care benefits. These contracts come with couples discounts and preferred health discounts. Those are simply applied to the contract, so the cost of insurance that comes out would be lesser if you have a couples or preferred health discount. Again, I'm not going to go through each one of these, but those are the big ones: is the return of premium, the crediting rate, and in terms of the old versus new product. Now, this is probably one of the most important slides in the presentation, and it talks about leverage and the type of leverage that our contract total living coverage provides. And so these are kind of generally speaking, directionally correct slides. This happens to be, I think, based on a 65-year-old. You're looking at the 3.85% crediting rate. We've got some couples discounts, but when we look at an age 65-year-old female, and we look at the long-term care leveraging table, at age 65, it's roughly 6 times the initial deposit that you put in there. And there's a slide that kind of highlights that in a little bit more basic way. But you're looking at anywhere from 9 to 4 times leverage from a long-term care perspective, and from a death benefit on the right-hand part of the slide, you're looking anywhere from a 3.3 down to a 1.2 leverage component for death benefits. So we're talking about, with a single premium, universal life with long-term care rider solution, being able to leverage that up for long-term care and death benefits. Here's the total living coverage approval map, new product versus our old product. And you can see, again, the new product is pretty much approved in all states except, California, Hawaii, Florida, New York, Connecticut. So, we're pretty much covered for the most part across the board with the new version of the product. But again, both products deliver incredible value. Here's probably the easiest way to explain total living coverage and the leveraging. And it goes something like this: 1's going to get you 2's going to get you 6. So with an initial premium deposit of $100,000, that would be leveraged up for a death benefit of roughly $200,000 that you would receive. If you were to pass away, your beneficiaries would receive $200,000. Should you live, you would have access to a long-term care benefit pool of $600,000. So the simple steps to determine, what you want is number one, how much do you want to move into or put into a total living coverage contract? It could be in the form of a 1035 exchange, or it could be, safe, liquid money that you just transfer, move from your left pocket to your right pocket. The next decision would be, do you want any sort of inflation protection on your contract? And a rule of thumb here is, at least, part of it's a philosophical component, and then part of it's just, the math works better. But anybody under the age of 53, I think, when you look at some of the illustrations here, you might want to consider putting like 3% compound on it. It just seems to work. But anybody above that age, really putting no inflation on the contract is reasonable and a lot of times, appropriate, because you get a greater leverage to that, to the amounts that will show up. But you can determine that with your clients just based on running some illustration scenarios. Here's my philosophical part of the inflation protection and why I have a tendency to tilt to not put inflation protection on these contracts is, if you think about who the audience for linked benefit products are, we talked about it earlier. They're self-insurers. They're people who have money on the sidelines who have decided that they will pay for it out of their own pocket if they have a health care need. Last time I checked, a money market account or a CD doesn't have much leverage to it in terms of the growth in the account. So they've essentially set up a plan of self-insuring that doesn't have much of a inflation component anyway. And this sort of approach still delivers incredible leverage benefits without any inflation protection on it. So again, do the math, look at the illustrations, and you come to the conclusion on your own. The third and final decision really is, what is the length of LTC coverage that you want in terms of the accelerated benefit rider and the extension of benefit rider. And really, for the ABR, accelerated benefit rider, which is just accelerating the death benefit first, there's a 2, 3, or a 4-year accelerated rider. On the extension of benefit rider, which is basically what happens after you've went through the ABR, there's a 0, 2, and 4. I can tell you that over 75% of the policies that are written here are what we refer to as 2x4s, 2-year accelerated benefit rider, 4-year extension of benefit rider. But the point of this slide more than anything is to help you with your clients in this fashion. Live, quit, or die, you're going to get something for this contract, and here's how it works. 1's going to get you 2, is going to get you 6. And we keep it that simple, and people are extremely interested, and then it just comes down to, okay, what do I get for that benefits and features-wise? And really, when we look at Genworth, and we talk about our linked benefit solution called Total Living Coverage, we're not talking about a watered-down solution here at all. We're talking about a robust long-term care plan in our Total Living Coverage contract that is based on our Privileged Choice Flex traditional long-term care insurance chassis. So it comes with 0-day elimination period for home care. It provides for informal caregivers. So somebody who's not licensed or not certified, but not a family member, we don't provide for that. But they could, so informal, uncertified, unlicensed caregivers, we'll provide benefits for that. So that could be a church member, or a neighbor down the street who comes in, does little light housekeeping, meal preparation. They can be part of that ultimate care plan. Comes with privileged care coordination, preferred health discounts, couples discounts, you name it. And it provides a lot of flexibility in terms of, the guarantees. So there's, again, the lifetime return of premium. This product is a comprehensive product and subject to comprehensive underwriting. And what that means is we actually place more business than our competition because of the amount of work we do in terms of turning over every boulder to understand if this is a risk we want to select. A good example of this might be, somebody who takes a medication for a certain condition might also be a medication for something that's a little bit more serious. What comes to mind for me, I think, is, and I can't remember the name of the drug, but it's the drug that's used for restless leg syndrome. That's also used for dementia symptoms. So I think it's important to understand the reason why certain medications are being taken, and our full underwriting gets to that point, versus the competition who might have a shorter, what appears to be simpler underwriting process, but some things never make the cut because they're declined on application, if you will. So we believe we get higher placement rates with full underwriting. Certainly in the area of protection, we deliver some greater benefits, 35% greater guaranteed long-term care benefits and death benefits to age 86. And 35% greater current LTC and death benefits for life. So, there's also what is referred to as a residual death benefit in our contract, and this kind of goes to the live, quit, or die. You're going to get something for it. The scenario being, let's say somebody puts in $100,000. They have a $200,000 death benefit and a $600,000 benefit pool. Let's say they trigger benefits for long-term care through loss of 2 out of 6 ADLs or severe cognitive impairment, and they go on claim and they work through that $600,000 benefit pool, and they exhaust it. They no longer have any other benefits available, but let's say they pass away soon thereafter. Their beneficiaries will still get a residual death benefit that is 10% of the initial death benefit that was established, that $200,000. So even in the scenario where they've exhausted all the benefits, the beneficiaries will have $20,000 of residual death benefit for end-of-life expenses or something like that. So it's covered in all areas and really delivers tremendous value. When we look at the old TLC, same sort of thing in terms of benefits and features. It's only what I had highlighted on that comparison chart earlier where you start to differ in that middle column where we've got the 15-year return of premium. And due to the lower current crediting rate of 3.5% and the guarantee, you've got a little bit softer benefits, 19 to 30% in those LTC and death benefit categories, but still significant greater benefits due to our crediting strategy as well as our full underwriting process. This slide just kind of shows that guaranteed value example versus the competitor, and you can see from a death benefit perspective at the various ages here how it compares to our competition as well as the LTC benefit pool, and it shows kind of that percent greater difference, new and then old. So significant benefits. And don't just take my word for it. Work with the folks at AIM, Mike and Dave and everybody there, the marketers, to look at some illustrations. We really compare favorably to the competition and deliver some solid benefits in terms of dollars and services inside our total living coverage contract. I'm going to pause here for a moment, Mike, and just, I don't know if you want to take a look if any hands have been raised or anything like that. You tell me, but before we maybe transition in how you go about transacting and what the process is, I'll just see if maybe there's a question or two that wants to be asked.
Actually, we do have one, so the timing is good. A question from one of our guys about a client who is VA disabled.
Okay.
And they've struggled to get in place with other products, and they're wondering what your thought is on that. For anybody else who's got questions, just hold your hand up on the control panel, and we'll get to you.
Yeah, good question, and I think it's best to kind of just answer it, generally speaking. And so, when we think of total living coverage, we underwrite for life, mortality, and for long-term care morbidity. So we're underwriting for both. So typically, if you can't qualify for any kind of life insurance or you can't qualify for any other kind of long-term care insurance, this product would not likely be a solution for you.
Okay. All right. Okay. One other question about the age. Do you round to the closest age?
Yeah, so that's a real good question. So old versus new, and I'm just going to go up real quick just to catch myself, and I'll get back to where I am here. So let's see, right here. So on the old product, that's California, Florida, New York, and one other state.
Connecticut.
Connecticut. Issue age is 18 to 79, and it's age nearest birthday.
Okay.
On the new TLC contract, 18 to 79 issue age last birthday. Okay. So we've got a couple of different versions depending on the old versus the new.
All right, very good. All right, one last chance for any intermediate questions here. Otherwise, we're going to let Dave kick it back off and keep rolling. So if you got a question, put your hand up using the control panel. Otherwise, we will resume and then take the rest of the questions at the end.
Yeah, and that's great. And I know we'll have ample time for additional questions too. So
looks like no other questions right now, Dave. So go ahead and keep going.
All right, great. So the process really is kind of and it says new here, but for the most part, it's the process that exists for the TLC product, and it's a pretty simple one. Sometimes these charts overly simplify things, but it really is a simple process in terms of working through a total living coverage transaction. And really it comes down to, the producer or agent's responsibility is to review the illustration, any of the state required forms, and there are some, believe me, just like the traditional. But you can go ahead and complete an online ticket or a long application. And if it's a 1035 exchange, there's a 1035 exchange form. You complete those. You submit them to Genworth, and what we're going to do is we're going to conduct a phone interview, obtain voice signatures where we do the online. We're going to schedule the paramedical exams and order any additional underwriting that might be needed. And we're going to go through the process of evaluating this risk, make a decision, and simply deliver the policy to the producer. So it's a real simple process. Our placement rate is about anywhere from 5 to 8% better than the competition, and that's due to our full underwriting approach. In other words, we're making sure that we've got all the facts straight before we make a decision, and we also have, some substandard categories that we can place people in terms of ultimately the risk category that's delivered. So so our placement rate is somewhere in the neighborhood of 62%, which is solid in this linked benefit arena compared to the competition. Our average buyer is somewhere in the neighborhood of 67 years of age, and the average face amount or initial deposit that is made, initial premium that is made, is about $70,000. So when we look at that example earlier of 1's going to get you, 2's going to get you 6, 70 is going to get you $1, 40 is going to get you, oh boy, what is it? 70 times
420.
420. You got it. Thanks for the help, Mike. Appreciate it. So real simple process. We've got some great resources. Obviously, you've got AIM to help for all your needs and support. But we've got a great website out there. It doesn't require passwords or sign-ins, and it's called genworth.com/TLC. And really what it does is it's kind of a one-stop shop. I mean, you have access to education materials, sales and features guides, underwriting guides, product overview, product brochures, a section right down here under sales ideas that'll show you PDFs of how we stack up against the competition. It is a tremendous resource. I would encourage all of you, if you haven't had a chance to take a look at it, take a look at this website again, real easy, genworth.com/TLC. So who's the target TLC customer? I told you what our average buyer age is right now, and they certainly fit right kind of in the middle of that category here. But really, you should be looking for clients that are between the age of 50 and 75. They've got assets they want to protect, for their family or otherwise. They've got a significant amount of liquid assets. So this is, when you look at this solution, it is skewing towards that upper end of the market. They may have some term life insurance that's expiring. So again, that old versus new question. They've said, hey, I like what you're talking about, but I really want to, I think I can self-insure against this risk. They're good health, and as always, we have strong benefits for couples. So that's really kind of your target customer. Here's a great case study, I think, that kind of brings it alive a little bit. But here would be an executive, age 60, understands the need for long-term care, but doesn't want to pay for a product may never need. It's got a $100,000 CD coming up for renewal. When you look at the solution being a total living coverage contract, you've got a $637,000 LTC benefit pool, a initial death benefit. Should he die, beneficiaries would have $212,000 of death benefits paid to them, income tax free. They've got their residual death benefit if they work through all of the LTC benefits of 10% of that initial death benefit, and they've got that full return of premium after the second year. So if they want to quit, they can get their money back. This is an example of a case study that is real. Let me give you another one. I actually, when I started my insurance career and when I first got married, my wife and I bought whole life policies. And I'm 51 years of age, and so I bought that, I think, when I was 24, 25 years old. $55,000 in cash value in it. Moved it over to total living coverage. That provided me with a $254,000 death benefit and a $685,000 long-term care benefit from a 1035 exchange of a cash value contract into a total living coverage contract. This is happening each and every day. There's a lot of people out there with old life insurance contracts that don't know what, aren't aware of the value that they could get just by taking a pretty simple, paper transfer and going through some underwriting improve their situation. So a significant opportunity for that. You know, I'll close this out and then open it up for questions. But you know, Mike and the folks at AIM could speak to this very well too. In that, you know, when we thought about long-term care historically, we've thought about it as a middle market play. And when you think about the middle market today, boy, that is vast and wide, isn't it? I mean, on one end you've got borderline poverty, on the other end you've got, you know, very affluent individuals and everything in between. And to think that there's one or two products to fit that spectrum, I think we've come to the realization that we need more than one product. Total living coverage is an example of that. At Genworth, you'll continue to see us evolve and bring to the market multiple planning solutions to address that vast and wide market. I'm extremely excited about that, because what I think that says to me is, hey, this long-term care event or need is not going away. It just means that we have to figure out maybe some different approaches for the constituents that we're serving, and I'm excited about that very much. So with that, I'm going to go ahead and turn it back to you, Mike, to kind of open it up for questions, and we'll take this one home.
Great, Dave. We do have some. First question: what can you borrow against the TLC?
So, like mostly universal life contracts, life insurance contracts, there are loan and withdrawal provisions, so you can do that. You really don't want to consider doing that, though, because what that ends up doing is it kind of deleverages part of the product and takes away some of the minimum guarantees. So really, you want to make sure that, you know, somebody who's buying this total living coverage is putting it in their safe deposit box, and it really has become their life and long-term care solution.
That's great. By the way, we've got everybody unmuted. We'll take. I'm going to run through a couple of other questions that folks already sent in, but if you're not going to ask, or if you've got something going on in the background, hit *6, please, to mute your phone so that we don't get overrun with background noise and such. So, okay, let's see here. 1035. Question about 1035 with term life insurance, but that can't be done because there's no cash value in it. So, are the materials and presentation available to work on the iPad platform? There, Dave?
Yeah, boy, that was a little feedback, huh?
That was, yeah. I think we might have got it zapped. So go ahead. Anyway, question was with regard to iPad, yeah.
Yeah, so if your iPad, you know, what I was just showing you in terms of the materials on that website that I showed, that'll come up on your iPad as well, just as it shows up on a laptop.
Okay, perfect. Question about qualified funds and the availability of using qualified funds with this.
Yeah, so at Genworth, total living coverage, it is only non-qualified funds that can be put into a total living coverage contract.
Okay, all right, very good. All right, that covers questions to this point in time. So anybody out there?
We have one more, Mike.
Go ahead.
If someone has $100,000 and they may need a loan later, should they split it and buy two $50,000 policies? Hit mass mute.
Yeah, so if they think they're going to need loan provision, you know, maybe need to take a loan at a later date, should they split it and have two policies, one for 50, you know, each for 50? That is certainly a strategy that you can adopt and has been adopted.
Perfect. Okay. All right. Any other questions out there, folks? You're going to have to raise your hands, and we'll unmute you individually because we're getting a massive amount of feedback there. In advance of that, while we're waiting, David, I appreciate your time again. Been very productive. I know that we did have a lot of questions there, a lot of folks interested in what it was you were having to say, and I would expect that we will see a flurry of activity kind of on the back side of this. So one more pass through for questions. Otherwise, we're going to let Mr. Soares close this one out and head off to do other things that fall within his purview. Looks like we do have one more that popped in. California and the new plan.
Yeah, when's it going to be approved?
Yes, question. Yeah, that's the question.
Yeah, we don't have, we're actively, working with the DOI to get that approval. At this time, we don't have a date in which it's going to, the new product will be launched. So I don't have any update for that. But in the meantime, again, you got a fantastic product with a guaranteed and current crediting rate of 3.5%. That's pretty darn solid. So.
Yeah, don't wait for the new product. In California, you could be waiting for a long time. You got a good one there now. Make use of it, get it in front of your clients, and start the conversations.
You betcha.
You bet. All right, one more pass through for questions. All right, if you want a copy of the presentation, I know Dave will get that over to me. Email me at mike.anderson, that's S-O-N, at whyam, W-H-Y-A-I-M.com. We will get that to you. The presentation here online will be archived and uploaded to our website by midday or so today. So if you want to come back in and take another look at it, you can do that. And with that, we're going to go ahead and tell everybody thanks and shut her down. David, thanks so much for your time. We'll reconvene here in June sometime and do another look at some of the various things that Genworth makes available for our agents.
So. Looking forward to it, Mike. Thanks, as always, for the opportunity. And, thanks to all of you who participated today. I appreciate it. And, have a great week.
All right. Thanks. Thanks, everybody.